We have been talking about inflation in the United States from three different perspectives, actually two different perspectives, and this one's going to be the third one. We're going to be talking about import prices and export prices in the United States. Might they tell us something about price increases, inflation? We're going to ask Jeff Snider what the difference is. Is there a distinction without a difference, or is there a very important difference between a price increase and inflation? Jeff Snider, the head of global research for Alhambra Partners. On the 15th of September, you wrote for the Alhambra Investments blog a piece that was titled "First Transitory in Producers, Then More for Consumers, Now a Negative for Import Prices." And you start out by introducing us to helicopter money, because we've been talking about camel humps that we see in graphs. And the first camel hump and the second camel hump was caused by helicopter money that was released by Mr. Trump and Mr. Biden. But guess what, Jeff? As you remind us in this very first article, we almost always forget that the helicopter was introduced at the start of this entire silent depression in 2008 by Mr. Bush. But we've forgotten about it. Why have we forgotten about it?
Because it was that good and that effective, right? It's something that is going to stand as an example for what government should do throughout the entire test of time, right? No, it's people forget about the Bush helicopter drop because it was just that forgettable.
Like gone.
Exactly.
I mean, it was overwhelmed by events.
And that's really kind of the point we're making here, is that yes, these can have a temporary impact. In fact, when it happened at the time it actually happened, it seemed like it worked.
Yes.
Because GDP in the second quarter of 2008 in the United States turned positive after being slightly negative in the first quarter. You know, the initial rumble of recession, all incomes, Bush 43 with his experiment with the U.S. helicopter, the tax credits that were deposited in people's accounts.
$300? Is that right?
$300 a person, $600 a couple. I mean, I forget the exact numbers because it's just that forgettable. Anyway, it doesn't matter. At the time,
at the time.
At the time, it was radical, right? I mean, back then it was like, oh my God, this is some brand new policy. How could it possibly fail? It's huge. It's immense. It's enormous. And again, as I said, the initial results were very favorable, very positive. GDP turned positive in Q2 2008.
And the FOMC in the meeting minutes, they were saying, you know what? I think maybe the worst is past.
That combined with their rescue, what they thought was their rescue of Bear Stearns, they thought this was enough. We have done enough monetary and fiscal policy to avoid any recession. This stuff has been so good and so effective. By the middle months of 2008, they're already talking about how inflation was going to be out of control and how they better get on to hiking rates. As we've talked about before, Emil, they were already doing that in Europe in the middle of 2008 because they thought this stuff really works really well. As we know now, of course, it didn't work at all. It had some temporary transitory effects. Yes, GDP was positive in the United States in the second quarter of 2008, but not again for a very long time. And it was one of the worst contractions since it was the worst contraction since the Great Depression up to that point. So whatever effects there had been from that original helicopter, they weren't huge, and they sure as hell didn't last very long. And that goes for the Federal Reserve too. The combined effect of monetary, quote unquote, accommodation or easy money, which none of those terms should be applied, as well as this direct injection of cash into the consumer wallet, temporary, transitory, small, limited impacts.
I don't want to apportion blame just to the Republican president, because shortly after that, we had our terrible crisis, but comes to the rescue who else but President Obama, who unleashed an even more gargantuan fiscal spending program that in his latest memoir, he is proud of, and he said it was sufficient and that it was on par, if not better, than what Roosevelt did during the Great Depression. So
I would agree with that, actually, but that doesn't mean it was effective.
No, that's exactly is what I'm trying to say is Then we had a Democrat, which, what's the word? We're supposed to say that they spend much more. That's the Oh gosh,
Yeah,
what's
they
the
have they
stereotype?
had the stereotype of being more profligate than the Republicans. But I'm
But
not even sure that stereotype was ever true at any point.
but did it save the economy from exiting the depression? No, we remained
Obviously
in
not.
one.
Neither did the
Did
New Deal. That's the point I was making. So
oh, I'm sorry, I didn't hear that. Perfect. Okay, sir. Yes, great. We're bringing all this up because we have forgotten. Of course, we have. It's been 14 years. Why should we remember all that stuff? At the time, we thought lights out. We're melting down the dollar down to the struts, okay, to the foundation. Here we are again, 14 years later. Now we've got a Republican president sending out helicopters, followed up by a Democratic president with more choppers and infrastructure spending. And the question is it going to melt the US dollar down to a little puddle? Is inflation going through the roof? We didn't see it. We saw it in a transitory manner in what? Producer price indexes, consumer price indexes, and now we're going to be looking at import prices, Jeff. Do you tell us, what did we see in
import prices maybe is where I think most people would expect it, right? Because it's been a goods frenzy. You see on the news the port traffic congestion in Los Angeles, Long Beach, and the West Coast, and everything else. So it would make sense that one of the main channels for consumer or producer or whatever commodity price pressures to be pushed through the U.S. economy via the global trade, inbound trade, import sector. Not only that, we've heard nothing about, as we talked about before, shippers and freight rates for the first time in forever that have gone through the roof into the stratosphere. Container rates, for example, just obscene levels. So it seems like a lot of this inflationary pressure, if it is really inflationary pressure, is actually coming in from the outside. It's coming through the import channel. And of course, the BLS does us a nice favor by keeping track of these various buckets of prices, of pricing activity, to give us a sense of, can we follow it from the import channel? Can we follow it from commodities and producers? Is it coming out into consumer prices? And so what we see from the import price index is that, yeah, there's that huge hump early part of this year. There's also the camel hump in the middle of last year. So we're already starting to see the double camel hump. And then, of course, we get past May of this year to June, and then July, really, and then August, where the idea of transitory isn't just in decelerating rates of growth. We actually now have an outright contraction in average import prices, even though the fact that embedded within the BLS index was a healthy and huge contribution from the auto sector. Auto prices are still going up at a relatively fast pace, and prices, I believe, are still accelerating in them. So even despite auto prices in the import index, it was still negative in August. And that was not just because oil prices were lower in August compared to July. The non-energy import index was also about 1% lower too. So it's a broad-based, at least 1 month retreat in import prices.
Export prices also are lower than they were in July for the month of August, whether or not you measure it year over year or month over month. And then import prices year over year and month over month also lower in August than in July. Perhaps this ties back to how we opened the show by discussing that French shipping company who says we're going to pause freight increases for containers because for some reason, and here we see it, maybe it's because of what we're seeing in import prices.
Yeah, and that's the one part we haven't really touched on in our 3 segments here yet. We've been talking a lot about the supply factors, the logistical problems, and all that kind of things. And as those things get worked out, we would expect prices to be transitory. But there's also the demand component too, because as prices go up, and a lot of, especially talking, inventory in the supply chain, all the inventory is being stuffed in the supply chain, it's presumed and assumed that demand would at least be relatively the same in the last half of the year and the early part of next year as it had been during the frenzy in the early part of this year. That the economy globally, especially the United States, would continue to progress along the same robust lines, and that as supply factors get worked out, they were at least getting worked out, and those lower price pressures would be absorbed somewhat by continually rising demand. And so we wouldn't expect consumer or producer or import prices to just come right down and crash. But if demand actually is not as robust as everybody was hoping it was in the early part of this year, and it doesn't stay as robust, then you would expect now you have a double price problem if you are a freight liner like the French firm CMA, what is it, CMA CGM. Then you have not just the supply factors coming off, you have logistical problems starting to get solved, but you also might have the issue of demand, and you also might have the issue of demand when a lot of big companies have been just double and tripling up on inventory, just hoping to get something to arrive in their shelves so that they have something to sell before Christmas. So you have a lot of potential demand questions that are starting to materialize right now that does have a lot to do with the import part of the U.S. economy, which is one reason why maybe we've seen the other side of transitory and import prices much more sharp and much more obvious in August, already in August, than in consumer and producer prices. That maybe there's some sensitivities and inelasticities there that are now working against the bulge in consumer, that second hump in the camel.
So to summarize, all month-over-month readings that we've gone over, PPI, CPI, export and import prices are lower in August than they were in July. And almost all of the year-over-year changes are lower except for PPI, which was higher.
Yes, the rates of change are lower, which means deceleration, second derivative. That's what we're talking about. But with import prices, it's actually negative. Import prices themselves, not the rate of change. The import prices themselves were actually, on average, lower in August than they were in July, despite the healthy increase in automobiles. So they were lower. That's already into deflation, discounting, which is a sign that maybe, you never want to take 1 month and extrapolate too far with it, but it's consistent with all these other things that we're seeing, which is that prices are starting to fall off. And if there is this possibility of demand coming down, then we'll have a situation where there is too much inventory, which historically speaking has always been disinflationary, if not outright deflationary. So the fact that it showed up in import prices already in August, it's a small alarm bell that says, first of all, transitory, yes, but maybe even more than just transitory price pressures.
The only two things that I can measure that are going up the other way are expectations as measured by the Federal Reserve Bank of New York and the University of Michigan of consumers. So those expectations are going up. We'll see what happens over the coming months and the rest of the year, Jeff. That's it for me for this episode. Anything that we didn't cover that you wanted to bring up before we head into the weekend?
No, I think we just need to wrap up. Again, inflation is an emotional issue. And we understand, when we're talking about, you and I were just talking about this off the air. How should we even talk about it? I mean, because when I say there isn't inflation, Emil, you always point out and, sort of cringe and look, people they don't agree with me because they say, hey, idiot, the consumer price index is up 5% for the fourth straight month for the first time since the 80s. How can you say that's not inflation? So I hope this episode has sort of clarified our position where it's not inflation, because it doesn't have the monetary component that would turn it into actual inflation, which is sustained over time. And what we're really seeing this year are the temporary transitory impacts of some other things. Yes, Uncle Sam, supply, logistics, all these other kinds of things that were, again, as we said, predictable. They're behaving predictably. We saw this happen last year already. And it's not the type of monetary inflation. I hate saying that term, but you understand why you have to say it's not the type of monetary inflation that would lead to actual inflation, which is monetary inflation. And that's what we're seeing over and over again. And again, not just in the United States. I know we focused on U.S. inflation rates here, but across the rest of the world, it's the same thing. China inflation never really got very high, and it's already receding. Consumer prices.
Dangerously low.
Japan never even got on the plus side. Once they moved to their base 2020 number, the small the positive numbers for their CPI disappeared entirely, and they have yet to see a plus sign despite, 130 trillion yen increase in the Bank of Japan's balance sheet. Europe, some of the inflation rates have gotten high in August, but that was entirely because of the base effect with last August. And even then, they're nowhere near what the U.S. counterparts are. So we're seeing receding inflation that didn't get very high out in countries around the rest of the world outside the U.S., and then the camel humps in the U.S. inflation rates that are becoming even more well-defined by the month.
Perfect, perfect. Thank you very much, Jeff. Thanks for teaching us, educating us, Eurodollar University. I can't wait to do it again. I'll talk to you again next week.
All right, take care, Emil.